Hello and welcome, I'm Sriyash Maheshwari and you are watching Last Tick here on News 9, where we bring to you the lowdown of the day's action on Dalal Street. Now, Indian markets extended their winning streak to 2 sessions, with Nifty closing above the 21,700 mark for the very first time since January 1. At close, the 50-share index was up 0.24% at 21,705 sort of levels. Now, this coincides with the 61.8% retracement levels of the entire fall from the record high of 21,834 to Wednesday's low of 21,500. The level works out at 21,705 and that's where we closed at. Meanwhile, sensex added about 163 points to close above the 72,000 levels. Now, the index last closed above 72,000 on Monday, the first trading session of 2024. Now, despite the positive close today, which is Friday, Nifty recorded a loss on a weekly basis as it gave away about 0.12%. This, by the way, is the only second weekly loss seen by the index since October of 2023. Moving on to the broader markets, they are showing no signs of slowdown. Pretty much they are hitting record highs on a daily basis. The Midcap 100, that surged by about 0.18% higher, and it ended just marginally below the 47,400 level. Whereas the small cap index, that surged by about 0.62% to end at 15,434 mark. Both indices, as I just mentioned, have scaled record high, and they have been scaling record high since the start of 2024, whereas headliners have turned largely volatile. Meanwhile, India VIX, with the fear index, continued to decline for the 4th straight session on the trot. Now, the index is back below the 13 sort of levels, and remember, just earlier in the week we were at 16. We had spiked from about 11 or so levels and had moved towards the 16 level mark, but we have corrected. India VIX has given up a lot of those gains. In fact, it's on a 4-day skid, and the index has managed to close below the 13 levels, which is for the very first time in 2024, and a close below 13 is also the first close below those levels since December 14. Now, this particularly augurs well for the bulls in a rising market. Moving on to the sectors, Nifty IT was a top gainer on Friday. Remember, before today's session, it had been one of the worst performing sectors. In fact, the worst performing of all sectoral indices on NSE in 2024. The index had given up about 3 to 3.5% or so before today's run up. But today, it clawed back, and it clawed back by about 1.3% or so. Auto was another sector that was in the limelight today for the good reasons. The index added about 0.4%. This was another sector which had been struggling since the start of the new year after the December auto sales number disappointed the street. Realty continued to move higher. The index has hit another record high today. The index ended about 0.26% higher in today's session. On the other side, the Nifty PSU banking index and the pharma stocks, now they saw some profit booking at higher levels. Remember, both sectors again were rallying before today's session all through 2023 as well as 2024, but today we finally saw some profit booking taking place. So if you think about it, those sectors which were not performing since the beginning of 2024 did well today, whereas the sectors which were performing ended on a flattish to a negative note and saw some bit of a profit booking. Nifty Bank, now let's talk about that. It ended flat with a negative bias, down about 0.2 or 3%, but it managed to stay above 48,000 level. Now, this is a critical level for the index. It has time and again in the last 3 or 4 weeks managed to take out those levels, but has struggled to close above it on a consistent basis. But today we finally, even on a red day, the index was able to close above the 48,000 mark. But with that, let's bring on board Mr. Kranti Batini, equity strategist at Wealth Mill Securities. Sir, thank you for joining us here on News 9. Always a pleasure speaking to you. Now, December saw the highest ever monthly additions in Demat account, and this is at a time when the markets are also at a record high. Now, when I was reading this report, it reminded me of that saying, when your cab driver starts talking about markets, it's time to sell. Does that thesis hold here?
Sriyash, good evening and Happy New Year to you. We are having the show in this new year first time. So
Happy New Year
yeah,
to you,
you
sir.
rightly mentioned the December number of accounts have added. The reason is there is a euphoria in the primary market space. That's what we have been discussing. And also opening Demat account have become very easy to the investors. Trading accounts opening is very easy to the investors. Just the digitalization brought a lot of change in terms of the account opening process is concerned. So that's driving the investors to come closer to the markets. Just with a smartphone, people are opening the accounts and started subscribing for the issues and started trading. So this digitalization brought the change. Coming to your point, once the Warren Buffett says when your hairstyler starts suggesting stocks, that is the time you need to be careful. But given the kind of momentum we are witnessing in Indian markets are concerned, the information is plenty nowadays. Earlier, when we started our careers in markets, the main problem is there was a very less information with respect to the stocks and the disclosures are concerned. Today, the issue is there is too much information, but the crux here is how we are interpreting the information, how we are analyzing the information. That is exactly investors need to habituate at this point of time. I don't think so. Markets are completely overvalued at this point of time. There is still some kind of headroom is there, but as you rightly mentioned, when your cab driver starts suggesting the stocks, but what kind of stocks he is suggesting, that is extremely crucial to take into cognizance before concluding whether the markets are overvalued or undervalued at this point of time. Still, we can see a lot of value in the frontline stocks, and also there are pockets where we can see a lot of earning visibility and also the value in the names. So it's by and large more about stock specific at this point of time. Definitely, you are right. It's a liquidity-led market, and also the sentiment is quite positive. So we are playing a very expensive musical chair. One need to think where the investor will be, on which stocks he will be, which stocks will be there in his portfolio when the music stops. But the $1 million question is how long the music is going to continue.
All right. And sir, that's why we come to seasoned professionals like you and do not take advice from our cab drivers. So, in a market like this where we are at record highs, Nifty and Sensex pretty much, they did correct, earlier in the week, but we have clawed back most of those losses. Where do you see opportunity?
Yeah, the opportunity is still there in defense space, opportunity is still there, the consumer space and infrastructure space, and engineering and capital goods still offers a strong earning visibility for the investors. Suyash, we need to go with the stock specific action in these stocks, and also any dip in these spaces in these sectors. The frontline stocks one can buy at dips. We have witnessed stock like Hindustan Aeronautics. The market cap getting multiplied from 1 lakh crores to 2 lakh crores. That means the stock created around 1 lakh crores of wealth to the investors in the past couple of quarters. So what we can see, the stocks which have a strong earning visibility, okay, they are performing well. So any dip in these kind of names, definitely it's a good entry points for the investors who are entering right now in these markets. So look for the quality at this point of time. That's extremely crucial for the investors. Probably they may not expect a multi-bagger kind of returns in the quality ones because they're always priced in fully. But their capital is secured. They can be happy with outbeating the markets.
All right. And Mr. Kranti, like we have been talking about a lot of froth, at least for the longest of time, we have been talking about this froth that is building up in the broader markets, but they, for one, are not showing any signs of a slowdown. We are hitting peaks on a consistent basis, and a lot of retail money is, riding in the broader markets. We have seen that in Amphi data. So what's your opinion there? What should a common man who has just started investing or maybe has been investing for the last couple of years or so, what should they do, who have made good profits on the small cap and the mid cap space? Should they book some bit of it out or keep riding the wave higher?
So yeah, sure. Okay, the best thing is, okay, uh, uh, when we plan to reach one destination within 1 hour
Hmm.
by different factors, if you uh, achieve your goal within half an hour, if you reach the half an hour ahead, just relax. Okay, don't try to jump and waste your gunpowder. So the same law applicable fuel in terms of the journey is concerned. Okay, so the same law applicable with respect to the investing also is concerned. So
Hmm.
suppose if my capital is doubled within a short span of time, better to take back the capital and stay invested with the additional amount. And pyramiding is always essential for the investors, especially in the mid and small cap space, because whenever the stock multiplies or gives a significant returns, the margin of safety in that particular stock gradually it will come down. So if
Hmm.
the investor is much confident about the earning visibility of this company, if there is a earning expansion that's going to take place, then there's no problem. If the investor have that kind of cognizance and knowledge, if the investors don't have such knowledge, always pyramiding, taking back the capital is extremely important in these
Hmm.
kind of market, because uh, uh, whenever there are sudden spots in the markets, one need to be always cautious. Of course, caution is the word, the advice where everyone gives at all the levels of the market. But taking back the money,
Right.
okay, one need to know when to sow a seed and when to pluck the fruit from the tree. That's extremely crucial in the
Hmm.
markets. If anyone is just waiting for the fruit, sometimes it can become rotten or fall down from the tree. So it's an art. One need to know when to sow a seed and when to pluck the fruit from the tree. Also extremely crucial in equity markets.
All right. And moving on, HDFC Bank has come out with its Q3 business updates. I'll come to you in just a bit, but let's just look at the numbers first. Now, India's largest private sector lender, HDFC Bank, reported a 62.4% YOY or year-on-year jump in its gross advances for the December quarter. On a sequential basis, however, gross advances were up about 4.9% or so. The domestic retail loans, that skyrocketed by about 111% again on a year-on-year basis, but on a sequential basis, they were up somewhere around 3% or so. The bank's deposits saw a 27.7% uptick year-on-year, but a meager 1.9% growth sequentially. CASA ratio, the current account saving account ratio, stood at around 37.7% in Q3 FY24 compared to 44% in the year ago period. However, on a sequential basis, it improved marginally by about 10 basis points or so. Now, a higher CASA ratio is generally considered favorable for a bank, as it indicates a larger share of low cost and stable funds, which can contribute to net interest margin and improve the profitability of the bank. But remember that the numbers on a year basis are not comparable, and last year's numbers are just that of HDFC Bank, whereas Q3 and Q2 numbers are of the merged entity, which meaning includes the numbers of HDFC as well, which by the way, remember the merger came into effect in July 1, 2023. Coming to you, Kranti, how are the numbers looking? Deposit growth at about 2% quarter on quarter seems to be lower than what the street was estimating, isn't it?
Yeah, you made the disclosure, the comparing the year-on-year comparison because of the merger is there. Now it's a standalone entity at this point of time. And Suyash, it's the largest financial conglomerate, HDFC Bank and HDFC Limited. When they got combined together, there are a lot of things get merged together, the books and all. So the one thing I can see is, even though the pace is slow, but it's running in a positive direction at this point of time. One quarter numbers, we need to allow the bank to settle down, because the bank is the second largest company in India with terms of the market capitalization. So we need to allow the bank to give ample time, probably one more quarter, okay, to see the brighter spots at this point of time. Right now, yes, the numbers seems to be less if you do the comparison quarter on quarter, but there is a aberration when we compare year on year. Okay, so it's moving in a positive direction. That's where we can see the same thing. We can see the reflection in the stock price also. The stock was in the consolidation. Now it is in very baby steps. It is inching upwards. So most probably we need to wait. Quarter on quarter comparison is slightly a shorter term at this point of time because of the size and scale of the business is concerned. Most probably we need to give, of course, because as a regulatory norm they need to give quarterly disclosures, but we need to allow the bank, the management to settle down further to show the strong set of numbers going ahead.
All right, wait and watch. That's the call on HDFC Bank. Kranti sir, always a pleasure talking to you. Thank you for joining us here on Last Tick, and a very, very happy new year to you, sir.
Thanks, Jayesh. Always my pleasure to share my views with you and the viewers of News9. Thank you.
Thank you, sir. But with that, we have completely run out of time on this edition of Last Tick. But stay tuned with us, as we'll be right back with Business Plus on the other side.
Ram's Ayodhya rebuilt. Ram Lala's Pran Pratishtha. Countdown to January 22nd. Dateline Ayodhya. Catch the mega coverage only on News9 Live.
Hello and welcome. You're watching Business Plus. We're bringing you stories from the world of business policy and economy. First up, let's begin with headlines. India is expected to peg its GDP growth forecast around 7% for financial year 24, in line with RBI's revised estimate, making it the world's fastest growing major economy. The National Statistical Office will release first advanced GDP estimates today. Reliance Jio added over 3 million users in October of 2023, while Vodafone Idea is unable to cut losses, lost over 2 million subscribers in October alone, as per TRAI data. Home Minister Amit Shah launches Tur Dal procurement portal with an aim to achieve self-sufficiency in production of pulses by 2028. India imported close to 1.9 million tons of tur and urad dal to meet domestic demands. And DGCA issues show cause notices to Air India, SpiceJet for fog-related flight diversions at Delhi Airport, flags concerns on the lack of trained pilots to operate flights in low visibility conditions. And no PLI for toy sector just as yet, as government puts new production-linked incentive schemes on hold. Will review the existing utilization on 12th of January. PLI schemes currently has an outlay of 1.97 lakh crore and covers 14 key sectors. All those stories right here on News9 with me is Karthik Malhotra. Karthik, hello. The top story, in fact, that we are doing at this hour and bringing to our viewers is in line with what RBI believes will be India's growth trajectory in FY24. Now, today is the day when we will also get some sense of what government feels will be India's growth trajectory. Could be in line with RBI's estimate of about 7%, or therewithal, plus minus a percent here, a percent there, or maybe 7.2 or 7.3%. But all in all, I think not quite in line with what India needs to achieve that growth target of 2047.
Yeah, I mean, you know, it's great to be overtly optimistic about India's growth story. But I think a little bit of pessimism or a little bit of realism is also, you know, required right now. Now, when RBI revised its growth projections from 6.5% to 7%, it was in fact discounting the high frequency indicators. And the 7% growth projection was also conservative, to quote Michael Patra. So, you know, it's not that RBI or NSO will come with very, very divergent views. I think you're right. It is likely to be in the range of about 7%, maybe, you know, 7.1, 6.9, 7.2, we don't know. But looking at the Q1 GDP growth at 7.2%, Q2 at 7.6%, it seems that there is definitely a case of India conservatively definitely reaching 7%, optimistically breaching the 7% target. This also comes at a time when global bodies like S&P, for example, is still pegging India at about 6.4%. UN is still pegging India at about 6.2%. So I don't know what bubble they are really living in, because with two robust quarters of over 7% growth, I think it is fairly obvious that even Q3 and Q4 being moderate will still lead growth over in the 7% region. Right. So that said, the problem really still is that, okay, so the good news first that if India grows at 7% in FY24,
we will still be the third largest economy in the world by 2030.
2030, yeah, I think much earlier than that, because India at 7% growth in FY24 on a base of about 3.73 trillion will easily be a $4 trillion economy. So that is a little bit of cheer. That is something to celebrate. At least it's a good headline figure, if nothing else. But my worry really is that if we talk about this Amrit Kaal and if we talk about India's overall growth vision, development vision, then from FY24 to FY27, the 23 years that we have in between, if India continues to grow at 7% average, there will be some years where we will exceed 7%. But let's not discount certain black swan events or certain policy measures that may not fire over this long period of 23 years, where growth could slip below 7% also. But if you were to keep an aggregated growth of 7%, India in the year 2047 will just about be in the vicinity of a $19 trillion economy. Now, put that in perspective. What is the size of China's economy today? China's economy today is an $18 trillion strong economy. 23 years from now, growing at 7%, if India is a $19 trillion economy, it's actually not great news for India. Currently, US has an economy size of about $26 trillion. We are assuming that while we are in the present day the fastest growing major economy, we are assuming that other economies over this march of the next 23 years will not grow as fast, or will not grow, even if they grow at a slower clip than India. The sheer volume of their economy right now, the magnitude of their economy, even at a lower growth, is actually going to continue to compound at a rate much higher than India's. So overall, the economies that we want to compete with, which is US and China, because of their current size being so ballooned, we will find it hard to compete with them.
All right, fair enough. Even if we find it hard to compete with them, what does it actually mean for Indians? For India to be one of the fastest growing major economies in 2024, it augurs well for India, even if we are not competing on a global stage, keeping in line with what our, some of our laggings are, and some areas where India has not done extremely well when it comes to making in India, manufacturing in India, because that is going to be one of the core areas and core focus of the government. But even that, at 7%, it is a good growth rate.
It's definitely a very good growth rate, right? Given the situation the world is in, given the entire world coming out of a health crisis, and then you have two wars at two fronts being fought, it is definitely a good number. But, you know, again, more realistically, if not pessimistically, I would still like to break down the large GDP data into per capita GDP. Okay. Now, if you look at the top 10 economies in the world right now, India's per capita GDP is actually the lowest in the top 10 economies. So at about $2,600 per annum, we continue to be among, the lowest sort of per capita GDP income economies. Compare this to US. US has an $80,000 per capita GDP. China has a per capita GDP of about $12,000. Countries even like Germany and Japan hover between the $30,000 to $50,000 per capita GDP. India at $2,600 is obviously a much smaller number.
All right. So while India is looking to grow at over 7% in FY24, may not be enough to meet its own targets and to compete with other major economies in the world. However, is likely to touch and become the third largest economy of the world by 2030. That is definitely going to happen at $4 trillion, almost at $4 trillion at the moment. Right. Could be reaching about $5 trillion by the turn of the decade.
Yeah, I
That
mean, a
is the
little earlier,
expectation.
maybe, by FY 28
20.
we'll get there if we
Okay.
grow at this rate.
All right, so while a mixed bag there as far as Indian economy is concerned. Shifting focus to telecom sector, which may not be a mixed bag at this point in time, and trends are absolutely very clear. Reliance Jio is adding millions of subscribers and users month after month, while competitors like Vodafone and Airtel are losing business. And you think of the October numbers, very difficult to digest. While Reliance, good for Reliance Jio, adding about 3 million subscribers solely in the month of October, Vodafone India losing more than 2 million subscribers does not augur very well for
Absolutely. In fact, when the data for the month of September had come, where Vodafone added 4 lakh users, you and I, Shweta, were sitting exactly in the same position discussing and casting these bells and aspirations of a recovery and Vodafone being back in the game, a turnaround for Vodafone, on the basis of Vodafone's two-pronged strategy. Number one, more robust 5G services, which it has rolled out. And number two, trying to retain the high value, high ARPU customers. So there did seem to be some sort of a 17-month jinx that was broken by Vodafone in the month of September. But back then, when you and I were sitting and discussing, we had said that let's not look at this single month aberration and let's examine this data over a period of time.
And you were right
the
to say
very next month, we've seen that Vodafone, which had added 4 lakh users, has actually lost 20 lakh users in the subsequent month. So all in all, I think there is no doubt that Jio continues to lead from the front and Airtel continues to be a close second. Both of them put together at 39% market share and 33% odd market share are commanding right now almost, or a little upwards almost of about a 70% market share. Is it fair to call India a duopoly just yet? Perhaps not, but I think it is definitely getting there. When two dominant